Hi, thanks so much for joining in. You're watching the Mutual Fund Show on NDTV Profit, and my name is Alex Matthew. Like the name suggests, this show gets you actionable insight on everything mutual fund related. And to that end, we've got that number on the screen. If you've got specific questions about mutual funds, then I'd invite you to send them to us on that number, and I will take them up at some point either today or in the coming days on this very show. Now, often we talk about a particular strategy or a theme that you need to know about in the mutual fund space, and that's exactly what we're going to talk about today. In fact, we're going to talk about one of the fastest growing categories in the actively managed equity mutual fund space. It is in fact a category that has become the single largest in terms of assets under management in the month of July. That's based on the latest data. It had assets under management of 4.21 lakh crore rupees, and a bulk of that, as much as 60,000 crore rupees in inflows, have come in just the last 3 months. So the growth has been absolutely frenetic. Which one? It's the sectoral and thematic category. And there are as many as 174 schemes in that category, by far and away the most number of schemes available in any equity category or any other category, to say the very least. To talk about what your approach should be and why people are so enthused by the options available here, I'm joined by Santosh Joseph, who's the founder of Germinate Investor Services, in studio. Santosh, thanks so much for taking the time.
Glad to be here.
Thanks so much for coming by. But let's talk about this. I'm sure that your clients are also asking you about several of these schemes. Hey, this new NFO is out. And the number of NFOs we've seen, 40 plus in the past few months itself.
Well, quite frankly, it's a tough question to duck because there is so many NFOs and there's some nice marketing material. There's some nice advertorials going on about investing in a sectoral fund like a PSU, which is done so well, or a transportation logistics, how it's the moment of time for us to be in the manufacturing space. Yes. Now, all these sound so good, sound so compelling. But the data there is talking a different number, that most of us are actually chasing returns than just the theme. Because the 2-3 dominant themes that you look right now in the sectoral or the thematic space, however we'd like to call it, is it begins with, let's say, the manufacturing theme. At some level, you talk about the defense stroke PSU theme. And, you know, in some cases, you also talk about the transportation logistic themes. Now, for the normal investor, all these sound like a promising long-term story. But when you dig a little deeper and you wonder why is this that investors so attracted to it, you will almost recognize that there's a recency bias to it. Now, what is a recency bias? That you're so enamored by the recent turn of events that you feel this is the way going forward. This is the story with PSUs, this is the story with manufacturing, and this is the story with transportation logistics. Now, when I looked at the numbers, there's a reason why they like it so much. You've got the Nifty at the headline benchmark giving you about 25% return last 1 year. But most thematics have more than doubled that outcome. For example, when you look at the PSU fund on the last 1 year basis, the best in the categories delivered almost 100% return. Now, why would you want that? Therefore, you see the...
Why would you not want that?
Why would you not want that? Exactly. So when you look at that and you look at the flows, is just, you know, coinciding that the flows are actually chasing the returns, and therefore the thematics are in favor right now.
But okay, before we get into some of these themes and what your opinion is on the option overall, are you surprised at all that we see that thematic and sectoral is now the single largest category in the actively managed equity space?
No, I'm not surprised, because if you notice, just exactly a year ago, we were talking about the mid and the small caps. And you notice that in most mutual fund houses, the small and the mid cap category became the dominant inflow sector. And also at that particular point of time, it was their past 1 year return that dictated those inflows. In fact, it had come to a point where for some AMCs, their mid and small cap had become larger than their flexi cap and multi cap fund. And we've spoken about it earlier in the show. Right now, the theme is for the thematics, where people are buying into the story and believing that these are long-term sustainable ideas, and they are just pumping in money without taking into account that the longevity or the time horizon or maybe even the risk that one entails by investing in such kind of themes. Now, if you're a savvy investor, getting exposure to this kind of theme while keeping in mind that your overall portfolio is not too compromised, there's nothing wrong with it. But for new investors, directly jumping into thematic and sectoral, there is caution to be.
Okay, let me say that I agree with a large part of what you're saying, but let me play devil's advocate. Okay, for the purposes of this conversation. You pointed out that there are several of these themes that have done incredibly well. We're talking about 100 plus. Even the defense fund has done, HDFC Defense Fund, Defense Index Fund, and that's available in the market, has done 130%, 100 and what?
PSU Defense, all are above 80%.
Right? So when all of this is done so incredibly well, why are we saying that it's not a good idea?
I'm not saying it's not a good idea. I'm saying there is a space for that in the portfolio. For example, if there's a new investor watching our show and they hear our conversation and say, wow, thematics are done well, and there's a new NFO or there's an existing fund that is completed 1 or 1.5 years, let me put my money over there against a multi-cap fund. Now, in a multi-cap and a flexi-cap, it's not that we don't have defense, we don't have thematics, we don't have PSU, but there's a right measure in it. Here, you're getting 100% exposure of that one theme or the one sector. Now, when there's a downturn or even there's a consolidation or even there's a cool off, the investor then will not want to continue to stay because what can go up also can come down or can consolidate.
But we've not seen that.
Yes, we've not seen that. Last 4 years, specifically, the markets are literally on a one-way street. Any small correction, whether 5 or 10%, has been bought into and the markets have roared back even faster than the way it got corrected. So therefore, the reason we are discussing this is we want the investor to also be aware that when you invest in a multi-cap and a flexi-cap, you're in for the long haul. You don't have to worry about the intermittent volatility or the ups and downs of the thematic cycles. We've seen these cycles before, Alex, and you saw in 2007 and 8, and even before that 2006, infra, capital goods, they thought there was no end to the world. And they kept on just buying, and those funds were swelling, and there was so much of inflows. And then came a multi-year lull for these sectors. Now even infra is doing very well right now after almost 8 or 10 year period of lull performance. So you do not want to be caught with a consolidation phase where you'll see no returns for years to come. But you should also be careful to say that I'd like these themes, let it be a meaningful and the right part of my portfolio.
Okay, so there is another argument that has been made, and even on this program it has been made, where if you are investing in that thematic and sectoral category, you should prefer thematic rather than sectoral because it is broader, because the pool of stocks that the fund manager has available to them is larger. Is that a fair argument to make?
It is a relatively fair argument.
Okay.
For example, when you go into sectoral, you are being micro-focused. When you go to thematic, it's definitely more broad-based than the sectoral idea, but not as much as the diversified idea. Now you're in the midpoint, so you're slightly better off than being sectoral. Now, when you look at the actual number of stocks in the universe between sectoral and thematic, that's where the difference comes. For example, a sectoral idea would have maybe 30, 40, 50 stocks at best.
Yeah.
When you come to thematic, for example, let's take the transportation logistics. From the manufacturers to the OEMs to the lenders to the retailers, you take the whole universe, you'll have 150 to 200 stocks or maybe slightly more than that depending on how lower you want to go in the market cap size. Now, a universe of 200 stocks is way better than a universe of 50 stocks because you got the whole play better for you. Likewise is the manufacturing opportunity or the defensive space or even the PSU space.
Or consumption.
Or consumption space. Now, what we are saying is that if you're someone who understands the risk and you want that front seat, front row action, then thematics are better, right? And so therefore, if you notice that, that's why new NFOs are coming in the thematic space than the sectoral space. And the investor activity there should also be measured.
Is it possible to have a diversified portfolio with multiple themes? So for example, okay, you have one fund, maybe a flexi cap or maybe a combination of flexi cap, multi cap, or what have you, or mid cap, small cap, and large cap. Okay, you've done your research, you've picked these three, and you've picked three schemes. You want to be across market cap diversified. Alternatively, if you pick 4 themes that at any given point of time you'll see 1 or 2 outperforming, and the other 2 may be not doing as much. Can you have that same amount of diversification?
Well, that is what many investors today are rooting for. What
That is why I'm asking.
Yes, what they're trying to do is they're trying to take the top 4 hot teams. I'm not saying sectors.
No, that's not what I'm asking.
No, they want to build
Sure.
a portfolio out of the top 4-5 teams.
But that's not what I'm asking.
Okay.
What I'm asking is, okay, let me spell it out further. So you're talking about banking and financial services, you're talking about IT, you're talking about consumption, and you're talking about manufacturing, right? So at any given point of time, based on where the economy is, one would assume that even if IT is not doing well, because say the US is not doing well, you have manufacturing in India that is doing well, construction is doing well, you have banking that is doing well at any point of time, and maybe a pharma or healthcare fund, not pharma but healthcare. At any given point of time, 1 out of these 4 schemes or 2 out of these 4 themes will be doing well.
Yes. So here's the example that you will just extrapolate that. If there are 5 themes that you invested and you believe that at least 3 will do well and 2 may be mediocre, the investor will not look at the 2 as good to have in the portfolio.
Sure.
He'll say, let me remove the 2 and double down on the 3.
Okay.
That's the catch. Now, what I was trying to explain is, if you are having 5 themes, you're way better off than one sector or one theme. But the point is, do you have the prudence to say, even if 1 or 2 teams don't perform intermittently or in the short term, I will not plug it out, because then you're giving away diversification. Then you're giving away the risk measurement that one needs to pay heed to. You should be patient and let all those 5 themes play out, because that's exactly what a diversified fund is trying to do. Because the other advantage that you have in a diversified fund versus this 4-5 thematic ideas is that there is an auto balance or rebalance mechanism that your portfolio manager is doing on your behalf, because he's also privy to the same amount of information that you have. So therefore, he tends to increase the exposure or cut the exposure in line with valuation and in line with the market sentiment. Whereas you as an investor will either plug in a fund or just pull out the whole funds from your portfolio and then try to double down on the ones that are doing well. And when the market turns, you may have a rough landing.
I want to ask about the construction of the portfolios of some of these themes. And I've just taken an example here, not necessarily to poke at this one scheme, but as a valid example. I'm looking at the Quant Infrastructure Fund, and I'm looking at the top 2 holdings. It is HDFC Bank, which is 9.5% of the assets under management, and Reliance Industries, which is close to 9.5%. My question is that these are not necessarily stocks that are known as infrastructure plays. Reliance Industries is a diversified play. You have oil and gas, petrochemicals, you have retail, you have geo, telecom. HDFC Bank has a very large retail book. Now with the combination of HDFC has a very large mortgage book. It's not infrastructure per se. So is there a danger, and do you see this across the board? It's not just Quant that I'm picking up. Are they true to label?
Well, the provision for a fund manager from the scheme objective deviation gives you that 10 to 20% leeway to go outside the investment mandate only to that extent. So therefore, you'll notice that some of the top holdings, they are there which will not essentially meet the name or the scheme objective of the fund. So therefore, sometimes you'll have to discount that and give it to the fund manager that he's trying to do something better for the larger portfolio by adding some.
What is the rule though?
The rule is about 20%. There is a leeway or complete discretion of the fund manager that what he'd like to do in terms of the scheme objective versus the stocks that you buy into the portfolio.
And there are no other rules in terms of the individual stocks that you're holding? Because, for example, the HDFC Defense Fund has, what, 40+% in the top 3 holdings?
See, there are the regulatory norms, and then there's also the norms that their own internal policies of investment policies will be. Typically, they don't allow you to buy more than 10% of any stock in the portfolio, and that's a good measure. Yeah. But internally, there could be an 8% or a 5%, because you also have to factor in mark-to-market appreciation of the particular stock in the portfolio. So that 10% is at individual security level. But at overall level, even in a small cap fund, sometimes you'll notice that when you pick up a typical small cap fund, there'll be the largest of the large cap being the top or the second top holding, is because it's basically that small percentage where they can take the deviation. And because it's a large cap stock, that pops up right in the top 5 or top 10 holdings. Yeah. Now coming to HDFC Bank, most people say, most people will say, I buy HDFC Bank because if infrastructure has to do well, there has to be a financier or someone who can create the leverage for the person creating infrastructure or for the person wanting to consume infrastructure, you need leverage at some particular point in time. So they say we are playing the funding route to infrastructure because it begins with funding and then there is an execution on the roads. So therefore, that's the difference, that why people play financial services for the infrastructure play.
Okay, closing comments on sectoral and thematic. What do you need to bear in mind if you are in the market for these schemes? And I know that thumb rules, people often say, what, 20% of your portfolio at the very most of your equity portfolio. Do you ascribe to that? Can you go over that? In what situations can you go over that?
See, there's a reason why the thumb rules are at 20 or 30% of the portfolio is because most often than not, markets actually change faster than you can imagine. In fact, the last 2 to 3 years is a good example of how we saw the renaissance of mid and small cap. We saw the emergence of some of these thematics that sometimes you wonder, how did you miss them? Like, how did you miss manufacturing? How did you miss PSU? And PSU was there at this valuation for years,
yes,
and nobody bought it. Now, you're getting into a territory where some of us fear, are we being overbought in the space of manufacturing and PSU? Because they're all not new. In fact, if you notice some of the names, that they've been longer than you and I have been in the industry. Now, there's caution to be advised, and therefore, the way you exercise caution is the way you control your exposure to these ideas. Of course, when their going is good, they give you outsized returns, but you also want to protect your downside, because investing is so much so not only about making money, it's about also protecting your loss. That's why we talk so much about diversification, right sizing your portfolio. So when you have a 20 to 30%, you got a meaningful participation when the returns are good. You also have a protection when the returns are going down or there's consolidation. All the concept of diversification and having thumb rules is so that the investor can stay longer. Remember, the guy standing last is the winner.
Absolutely. On that note, we have to slip into a very quick break. We've got viewer questions, some that you have sent us, of course, to take after this very quick break, so do stay tuned. Hi, welcome back. You're watching the Mutual Fund Show. And I must admit that sometimes reading the questions that you sent in give me a lot of happiness, particularly because a lot of times they are very well thought out and you've already more or less got the answer right. You're just looking for that validation, which hopefully Santosh will be able to provide you with. Rahul Yadav has got the first question today, and he's investing 5,000 rupees per month each in 3 mutual fund schemes. It's Parag Parikh Flexi Cap Fund, SBI Mid Cap Fund, and Axis Small Cap Fund. He's looking to do this for 25 years and with a 10% step up. You have hit this out of the park already, Rahul, and this is without even going to the expert, I know for a fact. Please tell me I'm right.
No, he's right on all counts.
I'm glad.
So, number one, he's right for starting an SIP. He's right with this 10% step up every year. And third, also the choice of funds. I'm glad it's not a thematic fund, but a nice flexi cap fund and a good basket of them. Now, where this gets interesting is to have the forethought to do an SIP and pre-commit to a 10% step up every year. Do you know by the time he ends his SIP, the quantum of money that he'll be saving is almost 3x, 4x of what he's starting with.
Right.
And all this is going to happen with minimal effort year on year, thanks to the automated method of doing a 10% step up. And believe me, when you take an SIP extrapolation number at this number to how much he'll earn with a step up, the numbers also compound for him. So I think the answer is
do you have that? Do you have that? Have you at all worked out? So even if you take a conservative estimate, did you by any chance do that?
So let's do a simple example. If you do 5,000 a month, right, you're doing 60,000 a year.
Yeah.
And in a 10-year period, you do 6 lakh. In a 20-year period, that's 12 lakhs.
Yeah.
Now he's doing 25,000. So that's 12 into 6, almost doing 60 lakhs.
50, he's doing 15,000.
15,000. So
Yeah.
basically that is 12 into 3, 36 lakhs.
Yeah.
Now the 36 lakh is at even a 10-12% CAGR over a 20-year period could easily be some 80-90 lakhs.
Right.
And the last 20-year numbers are superb, but let's take only 10 to 12%. Now with a step up, the amount of money that he saves, that 36 lakh will become almost 70-75 lakhs. Now you take that and compound it because of the 20-year
That's just the principal amount.
Yeah, that's just a principal amount that he will maybe be at 1.4, 1.5 crores.
Easily, at the very least.
Very easily. And if the market supports him for this kind of a good investor with the right approach to SIP investing, there'll be even more upside.
Absolutely. I would say that he would be hopefully you will remember us, Rahul, in 15 years' time when you're rolling in money. Akshay has got the next question. He's currently invested in Axis Focused Fund as well as the ICICI Prudential India Opportunities Fund, SBI Technology and HDFC Banking Fund. The total SIP value is 52,000 rupees per month. All of them very narrow schemes. Okay, so he's asking, okay, the question is not whether you should continue to do this, but maybe you can weigh in on that. But he's looking to invest in the EV scheme or EV theme as well. Do you have a suggestion?
So it looks like one is going for the thematic route that we just spoke about. Now, we all know that the EV is the hot thing, and if not already the hot thing, the next hot thing that we are all looking forward to. Now, first of all, in India, the direct EV theme play is very limited and very small, and therefore the need to be in it, or the FOMO is very high to be in the EV theme. You want to be the first guy investing in that story. My advice is that it's better off that you are in diversified funds. Eventually, when more and more EV names and EV listings happen, they will find its way into the portfolio and you will do better for yourself. Considering that you're a long-term SIP player, the funds that you have in itself will find a way to incorporate those kind of EV themes. Now, having said that, just recently we did have a new age mutual fund company, Grow, launch its own EV ETF and fund of fund. So while there is an opportunity out there dedicated for the EV theme, but I would think from a long-term perspective, it's better off to be in a diversified equity fund where EV will be a part of the portfolio than just take a shot at the EV space in itself.
And hopefully what we spoke about at the start or through the conversation so far, Akshay, will benefit you when you're thinking of the allocation that you have towards thematic funds. Khurshid has got the next question. He's 60 years old. He wants to invest 2 crore rupees in a single scheme for a period of 5 years, and that is the Tata Tourism Index Fund.
Wow. Well, no doubt the last 2 to 3 years, the tourism, bunch of stocks have done phenomenally well. You talk about the hotels, you talk about the airlines. There's reason to believe that the tourism opportunity in India is largely untapped. In fact, most of our cities, we are not yet geared up for tourism as a concept. Now, if the government policy or even the public-private, some activity towards tourism, kicks in, there's huge scope for that growth. But having said that,
I was waiting for the but.
Yeah, those narratives aside, it's just too much at that age to put this kind of lump sum into a tourism fund. I think a good multi-cap or a flexi-cap fund, maybe you can sort these funds based on the sectors where they have exposure to, where you feel that tourism is well represented. It could be from hotels to those travel companies to even airline companies, or even to some extent to ticketing companies. If they're all incorporated, I think you should do well. Please remember that the boom at the ground level and the boom at the stock price level sometimes are disconnected. Of course, there is exuberance when the ground level activity is good, that even the stocks actually tend to flare up quite a bit. But from an investing perspective, exercise prudence and ensure that your money also is safe while you also participate in the boom. Now, this time it could be tourism, tomorrow it could be some other story. It's nice to think forward-looking, but also be cautious while investing.
Khurshid, I hope that answers your question. Avoid is the advice. The last one, we have just a minute. 47-year-old Vinay is asking about an SIP in the following funds. He's got 3 to 5 years. He's looking to invest 20,000 rupees per month. Nippon India Growth Fund, PGI Mid Cap Opportunities Fund, and HDFC Infra Fund.
Again, we see 1 or 2 thematics present over there. So the good thing is that you have a mix of both thematic and diversified. I would suggest you go more into diversified. Keep maybe one thematic in place, but I think the good thing is you're considering a SIP. I'm guessing you're starting now at 47. It's better to be more diversified than thematic right now. And also you're saying 2 to 3 years. If you just broaden the horizon, you'll do well for yourself. It's a great way to make money.
3 to 5 years may be a little short, right?
Yes.
You'd think of 5 years plus if you
Even
can.
in a diversified fund, it may not be the best time to consider an SIP. A little longer horizon always gives you better results.
Santosh, always a pleasure having you on the show.
Alex.
Thank you so much for coming by. And viewers, that brings us to the end of this edition of the Mutual Fund Show. It's been an absolute pleasure bringing it to you. Don't forget that number that just flashed on your screen. That's where you send the questions to us, and we'll take it in the days to come. Do stay tuned. This is NDTV Profit.